I'm Richard Murphy. I'm making a series of videos about why we should be taxing multi-millionaires more. I'm particularly focusing on multi-millionaires because we have a massive problem with inequality. Look at the links below this video and you'll see the others that we've been making to explain why that is an issue. But as with all my campaigning and all the work that I do, I'm interested in solutions and not just moaning. And the solutions to this problem don't come just in the form of a wealth tax. In fact, I'm not even sure that they do come in the form of a wealth tax. If it does, it's a long way down my list of priorities. What I'm much more interested in is actually having changes that are deliverable fairly quickly. And one of the ways in which we can deliver a change is to tackle one of the issues that I've discussed in an earlier video where I explained that national insurance is a deeply regressive tax in the UK because it is only charged on earnings from work and not on earnings from rent and from investments and savings and trusts and so on. And it also is only charged at the full rate on earnings from work up to £50,000 from when the rate is cut. So we need to change this. Now, we could, of course, make some changes to national insurance itself to deal with the fact that higher earnings from work aren't taxed. But the real problem is that actually it's so easy to get around this tax by simply shifting earnings which are from work into the form of earnings from investment and then avoid paying this tax charge altogether. Now, that is what many self-employed people have been doing for a very long time, using limited companies to change their earnings from work into dividends and try to avoid tax. And I admit that the government has taken some steps to try to tackle that, but insufficient steps, and they still haven't tackled the big wealthy person who has a substantial portfolio of shares and savings or income from rents. They still get away with this overall idea that earnings from real investment income should somehow pay a much lower rate of tax than should earnings from work. Now, there is a way around this, and it's called an investment income surcharge. And we had one in the UK from the 1960s to the mid-1980s, and it was charged at 15% additional income tax if your earnings came from investments. And the logic was quite straightforward. Where did the 15% come from? It was simply meant to compensate for the fact that you weren't paying national insurance, but you were getting the benefits in your income and personally, of course, of there being a social safety net, including the payment of an old age pension to the majority of the people who will be getting income from investment, and of course from the benefit of having the NHS available, which everyone in the UK, without exception, gains benefit from. So the investment income surcharge was there to try to level the playing field. A government, the 1960s Labour government, that knew that the wealthy were getting away with a tax break, put in place a tax to stop them getting that advantage, and Margaret Thatcher took that tax away, giving the wealthy their advantage again. We've never corrected that fault. Well, I'm suggesting we should. So what would actually happen? Well, a person would, of course, declare their income on their tax return. If you're wealthy, you're going to prepare a tax return. In the UK, around 10 million people a year are expected to make a tax return out of about 32 or 33 million people who actually pay income tax. The rest are basically earning income from employment or pensions, and their situations are so uncomplicated that they don't need to make a tax return. But the wealthy simply aren't in that position. Of course, they have a wide range of sources of income. They probably have higher rate tax liabilities. They probably have capital gains. They have rents and all sorts of things they need to declare. And at the end of the computation of the tax liability, what would happen would quite simply be that all the income that came from investments would be totted up. And I do quite specifically mean this is income from savings, so things like interest, income from things like dividends from companies, income from trusts, so trust distributions, and rents in particular. Those are by far the most common of the types we're talking about, but there's also variations on things like returns from life insurance policies and so on. Let's not worry too much about the absolute detail of that. You get the idea. Add those up and then quite simply charge an extra 15% tax on them over a limit. Allow for there to be a tax-free element of this, just as there is for earnings from employment with regard to national insurance, so around the same level. Give that element tax-free, so this won't impact those on low levels of income from investment. I mean, low level 9,000 or more a year, that's a pretty big amount of income to earn from rents or investment. And then charge this 15% tax. It would be very difficult to avoid. It would be simply part of the tax return calculation. Would it raise revenue? Yes, significant amounts. How much? Well, maybe 10 billion a year is around my estimate, but all these things are a bit give and take because we can't ever be quite sure of the behaviour or responses. But the point is, we would have created a level playing field, and that is absolutely critical. Inequality matters in the UK. Everyone has to be treated fairly, or there is a resentment against the tax system. And when you get resentment against the tax system, you get people who try to cheat it. We can't afford people to cheat the tax system. We want there to be the rule of law enforced. We want people to comply. We want the government's policies on redistribution to work, and that requires the tax system too. We want the government to be able to deliver its fiscal policy, its plans for our economy through the tax system, and therefore we need it to work. And we want the tax system to reprice market failure, which it can do, and for that reason we also need the tax system to work. And therefore we need to have buy-in from everybody into the social justice of this. An investment income surcharge will help deliver that level playing field, that buy-in and that social justice, as well as raising some revenue, which is almost an incidental, but of use. It's of use because it also helps tackle the accumulation of wealth by the wealthy, which is fueling the inflation of asset prices, which is spilling over into and having an impact upon the well-being of people who don't have wealth through, for example, rent increases. And the consequence of all that is we need this, and we need it now, and it would be easy to do, and the precedents exist, and therefore we could get on and achieve it straight away. This is a wealth tax for today. Thanks for watching. If you're interested in what I've been saying in this video, please subscribe. There is a button below the viewing screen. If you're interested in what I have to say on Twitter, I'm at Richard J. Murphy on that medium. If you want to look at my blog, that's taxresearch.org.uk, and we have a Facebook page as well, Richard J. Murphy. So one of those things will get you more information on what this video series is about, and I hope I'll see you again soon.